Welcome to our channel. Lately the word recession has been used way too often, but what is a recession and how can we take advantage of it? In this video we are going to cover both these questions, since a recession period is the easiest time to increase your net worth and become financially independent. But first of all, what is a recession? A recession is a period of economic decline that is typically defined as 2 consecutive quarters of negative GDP growth. During a recession, businesses and consumers tend to cut back on spending, which can lead to a decrease in employment, trade, and overall economic activity. Recessions can also be accompanied by a decline in the stock market and a decrease in the value of investments. While recessions can be difficult for the economy and investors, they also present opportunities for those who are willing to take a long-term view. Historically, some of the best investment returns have occurred during recessions or bear markets. By investing during a recession, investors can take advantage of lower prices and potentially reap significant returns when the economy recovers. During a recession, it is important to monitor key economic indicators such as GDP, unemployment rate, and inflation. These indicators can provide insight into the overall health of the economy and can help predict when the recession may end. Additionally, it is also important to keep an eye on the yield curve, which compares short-term and long-term interest rates. A flattening or inverted yield curve can be a sign of an impending recession. Different sectors of the economy can be affected differently during a recession. For example, consumer discretionary and industrial sectors tend to perform poorly, while defensive sectors such as utilities, consumer staples, and healthcare tend to perform relatively well. It is important to understand how different sectors may be affected by a recession and to diversify your portfolio accordingly. It is important to keep in mind that the stock market and the economy are not always closely correlated. While the stock market tends to decline during a recession, it can also recover quickly once the recession ends. Historically, the stock market has recovered its losses within an average of 22 months after a recession. Additionally, while the stock market may be volatile during a recession, it has historically provided higher returns over the long term than other types of investments such as bonds. However, it's important to note that no sector is completely recession-proof, and it's important to do your own research. Value stocks are stocks that are trading at a lower price relative to their intrinsic value. During a recession, many companies' stock prices may be oversold, providing an opportunity to invest in undervalued companies that have strong fundamentals and good long-term prospects. Value investing requires a lot of research and patience. Bonds and other fixed income assets such as treasury bonds and municipal bonds can provide a source of steady income during a recession. As interest rates fall during a recession, bond prices tend to rise, providing a level of stability to a portfolio. However, it's important to keep in mind that bond prices can also fluctuate, and the value of your bond investments can decrease if interest rates rise. Alternative investments such as real estate, gold, and private equity can provide diversification to a portfolio and potentially perform well during a recession. However, it's important to keep in mind that alternative investments can be complex and carry additional risks. Timing the market is a strategy of trying to predict the best time to buy or sell investments based on market conditions. During a recession, it can be difficult to predict when the market will recover, and it's important to remember that past performance is not a guarantee of future results. It's important to have a long-term investment strategy and not to make investment decisions based on short-term market fluctuations. Diversification is key to managing risk, and it's important to have a well-diversified portfolio that can weather market fluctuations. In conclusion, investing during a recession can be challenging, but it also presents opportunities for those who are willing to take a long-term view. It is important to understand market conditions, how they may impact different sectors and assets, and to have a well-diversified portfolio, adjusted to your risk tolerance, that can weather market fluctuations. If you like this video, please consider giving a thumbs up and subscribe to support this channel. Thank you for watching.